This is Ralph Sass. This is Accounting 211, Chapter 4. Once again, we're going to plan on doing two about 15 minutes or thereabout videos. And so this one deals with what we call adjusting entries. And the idea behind adjusting entries is that and this gets back to some of the items we've talked about in the last couple of chapters, we're trying to match revenue and expenses. So adjusting entries are needed whenever revenue and expenses affect more than one accounting period. Okay, so what we're trying to do here is to match revenue with expenses. Okay, and what's going to be included, and the way you can tell it's an adjusting entry, is every adjusting entry involves a change in either a revenue or an expense and an asset or a liability. The way to think about it is every journal entry must impact the income statement and it must impact the balance sheet. Okay, so we need one journal entry, one part of the journal entry to affect the income statement, and the other part of that journal entry to impact the balance sheet. There are four types of adjusting entries in this video. This part of the video, I plan on covering two of them, which are assets to expenses and liabilities to revenue. And since I'm going to discuss them at that point, I'll talk about them when we get there. 3 and 4 will be discussed in the second video to chapter 4. So the first example of where we use adjusting entries is to convert an asset to an expense. And the ones where it gets included are depreciation. Okay, what happens with depreciation is we buy a truck, and the truck for 30 grand or whatever is going to be used up over the next 5 years. So to use my very simple example, that means we're going to have to take $6,000 of that truck and convert it to an expense every year. So that's one of the spots where this is done. Supplies, in the last chapter we talked about we bought supplies, we put them on the balance sheet, and then we used them up over 3 to 4 months. That's another example. And the other big one that happens, I mean, depreciation happens almost all the time. The other one that happens is insurance policies. What typically happens in insurance is you pay for 6 months of insurance, or possibly you'll pay for the entire year. You'll pay for all 12 months. And then what you'll do is you'll mark it to an expense 1/6 every month, or 1/12, depending upon how often or how much you paid. I have seen insurance policies. In the past, they've gone up to 3 years. So it's not fair if you include the entire insurance expense for an entire year, or perhaps even 3 years, in the month you pay it. So what we're trying to do is match our revenue and our expenses. So what's happened here is we had some transaction where we paid some cash, and we didn't always have to pay cash. We may have been buying the truck on a loan or whatever before we incurred the expense. So what we do is we have an asset. Best example of this is depreciation. We paid the 30 grand for the truck. Now we're going to depreciate it over its useful life. We paid the 12 months of insurance. Now we're going to use it up. So what we need is an adjusting entry that recognizes a portion of the asset consumed as an expense and reduces the asset amount. Okay. Typically, these are done at the end of the current period, probably monthly, depending upon the situation. Might be done quarterly, but as a general rule, they're going to be done monthly. Okay, and this is a perfect example. Suppose you paid 18 grand for an insurance policy that was going to cover 12 months. What you would do is that means there is $1,500 of monthly insurance expense. How'd they get the 15 grand? Or pardon me, 1,500, they took 18 grand and divided by 12, 18,000 divided by 12. So what we should do is every month we should convert $1,500 to an expense, okay? And in addition, what would happen is every month that we convert it to an expense means that this asset, that insurance policy that started off at 18, after 1 month is going to be 16,500. Okay, after 2 months, it's going to be 15 grand, and it's going to go down and down and down and down until eventually at the end of 12 months, it's it's at 0. So the asset's going to get smaller and the expense is going to get bigger. So notice what happens when we buy the asset. We're going to put it on the balance sheet, and this is a good old journal entry, as unexpired insurance. Unexpired insurance is an asset, okay? That's an asset. And because it went up, we're going to debit it, okay? Cash is an asset, and that's going to be credited because it's going down, and we debit it for the entire 18 grand. So what happens is we put this insurance policy on our balance sheet for 18 grand. The reason this makes sense is theoretically we could go and cancel the insurance and get some, probably not all, but some of our money back. So what happens then is at the end of the first month here, we credit unexpired insurance for $1,500 to reflect the amount we used up. So now the balance will be $16,500, and we debit insurance expense for $1,500. And what we've just done is turned an asset into an expense. Notice it's an expense. How do we get expenses to go up? We debit them. Unexpired insurance is an asset. How do we get assets to go down? Is we credit it. So this fits exactly with the overall debit and credit policies and ideas that we were talking about in the last couple of chapters. And then notice what's happened on the balance sheet after that first month. The balance of unexpired insurance has fallen to $16,500, just as I mentioned before, and insurance expense has gone up to $1,500. And what's going to happen is we're going to do this entry 12 times. And when it's all done at the end of 12 months, this number here is going to be 0. This number up here for insurance expense is going to be up to $18,000. So the whole goal here is to, take that unexpired insurance and ultimately, over its useful life, which in this particular case is 1 year, turn it into insurance expense. The other item where this occurs is depreciation. And we're going to have an entire chapter later on in the text on this, so I'm not going to spend too much time now. Depreciable assets, what we're doing is we're taking the cost and we're putting it into an expense over its useful life. And officially the book definition is depreciation is the systematic allocation, okay, is the systematic allocation of the cost of a depreciable asset to expense. It's a way to turn the $20,000 or the $30,000 that we bought to that truck from an asset and turn it into an expense. We're going to talk about other ways to do this, but notice what happens. When we originally buy the item, okay, we put the truck on the balance sheet as a debit and we credit cash. Then as we use it up, we have this depreciation expense, which is a debit, and that's going to be my income statement item. And then we're going to have an accumulated depreciation down here, which is my balance sheet item. And that number is going to get bigger and bigger and bigger. And I'll show you how that's going to show up on a balance sheet here in a slide or two. And we're going to talk in much greater detail about how you go ahead and calculate this. But let's just assume they purchased a building, useful life at 240 months for 36 grand. I know the numbers aren't realistic, but let's just go with it. What you do is you take the cost of the asset, in this case 36 grand, we'll talk about some other ways to do it later on, divide it by its useful life, which in this case is 240 months, and what we do is we come up with a depreciation expense per month of $150. So what's going to happen is every month we're going to make this journal entry, depreciation expense building, $150. That's going to be that's an income statement item, and since it's an expense and a debit, makes perfect sense. And then we're going to have this new account. It's called accumulated depreciation building. Okay, and now this is an asset account, but it's an asset account that we are crediting. This is not the only time we're going to do this, but we'll have a couple of these throughout the course of the semester. And it's called a contra asset account. And when you see a contra asset account, what that means is it's an asset account with a funny balance. Typically, asset accounts have debit balances If it is a contra asset account, that means it is an asset account with a funny balance, so it is going to have, in this case, a credit balance. Okay, and notice here we've got, once again, we've got tools at 12 grand, over 60 months, that's 5 years, so it's $200 a month. So we have depreciation expense, once again, that's our income statement item, and then we have accumulated depreciation, in this case it's called tools and equipment, and that's our balance sheet item. And then notice how this is going to show up on our balance sheet. Okay. What we're going to do is we're going to have the building, and that's how much we paid for it. And once we put it on an asset, once we put an asset on the balance sheet, we don't change that value. And then right underneath it, we have another account, which is my contra asset account, less accumulated depreciation. In this case, it's $1,650, so we've depreciated it for a number of months. And that gives us $34,350, 36 grand minus $1,650, $34,350, which is what is our book value. And book value basically means what it's on our balance sheet for. So the number that's going to show up on our balance sheet, and it depends upon how they do it, that number right there, that 34,350. Some people will put the building less accumulated depreciation. If you take a look, go to Home Depot or go to Lowe's or Walmart, what have you, they will include building less accumulated depreciation all on one line. If it was a big company, they would have just shown you this 34 grand, but in their records someplace they'd have that 36 and the 1650. You do the same thing for all of your long-lived assets that are depreciating. You've got, in this case, tools and equipment 18 grand, less accumulated depreciation at 2200. Book value is 15,800. And that accumulated depreciation number is going to get bigger and bigger and bigger as time goes on, and that book value is going to get smaller and smaller and smaller. Moving on to the next of our adjusting entries, what we're doing here is converting liabilities to revenue. Examples include airline tickets and sports teams sales of season tickets. My favorite example here is Virginia Tech, just because we can relate. What happens is in February or March of the year, you go ahead and you buy your season tickets, okay? And what happens at Tech? Well, Tech collects cash in advance. They collect all the money for all the home games in advance. And to them, it's not revenue at this point. What it is it's a liability. And the reason why it's a liability is they owe you those football games. So what happens is when they collect that cash in March, April, May, whenever they collect it, they put it on their balance sheet as a liability. They owe you the games. Theoretically, if they don't play any games in the fall, they have to give you that money back. Now, what happens, and here they've got it at the end of the current period, it could be after every game, okay? After every game, they have now earned that 1/8 or 1/10, whatever, however many home games there are, they've earned that amount. So what they need to do is they need to recognize the amount that they earned as revenue and reduce the amount of the liability because they no longer owe you, let's use 8 games, they no longer owe you 8 games. Now they only owe you 7 games after the first one is played. So what happens is they need to turn that liability, they owed you 8 games, into we only owe you 7 now, and that one game, whatever that price is, becomes their revenue in that particular period. The example that the book typically uses, and the book we're going to see, the problem we're going to see in many of the exercises we work on, is rental. And what happens is a company collects rental in advance. So they collected $3,000 of rent in advance for 3 months. Okay, so what they did is they received $3,000 in advance for the 3 months rent. So they're paying them 3 months at a time. Notice when they paid, when they earned the money, or when they didn't earn the money, but when they received the cash, cash went up by the full 3 grand. Why? Because that's how much their cash went up. You paid them for all 3 months. But then notice they have this unearned rent revenue. That is the amount of money that it's a liability account they owe you, if you will, 3 months of rent. If the building burns down, theoretically, you'd have to return that $3,000. Well, then what happens is a month comes along and you've earned a month of it. So my debit now is unearned rent revenue. Okay, it was a credit. I'm going to skip back here. We credited it for $3,000. Now we debit it for $1,000. So what's the value? What's the balance in that account? The balance in that account is $2,000. And what's my rental revenue? And keep in mind, this makes perfect sense. This is my income statement item. Okay, this is my income statement item, rent revenue. That's gonna, and since it's a credit, it's gonna go up by $1,000. Makes perfect sense. Keep in mind that unearned rent revenue is my balance sheet item. So I've got one income statement item, one balance sheet item. That is a perfect example of an adjusting entry. Okay, and notice what happens. Okay, that liability goes from $3,000 after a month down to $2,000. Okay, and after another month it'll go down to $1,000, and then ultimately after that it'll be down to 0. And my rent revenue is going to go up every month by $1,000, so it's going to be $1,000, then it'll be $2,000, then it'll be $3,000, and then theoretically you're going to pay me another $3,000 for the next 3 months rent, and we will do it again. That concludes the first part of the Chapter 4 lecture, and I will continue with the other two methods, adjusting entries, in the second part of the lecture on Chapter